Why is my insurance company and hospital system fighting over a contract? You've probably seen this in your city or town where the big hospital system is threatening to drop out of network with your company's insurance carrier, and you'll see finger pointing from the hospital claiming that the insurance company is not wanting to pay them fairly, and the insurance company is saying that the hospital system is being egregious and asking for huge price escalations. What does this mean for your business and your employees? And what does it mean for the broader insurance market? What's it going to do to the rates? I'm going to talk about those three things today, but most importantly, what you should be thinking about as an employer that offers insurance. You're trying to offer the best benefits you can to your employees, but you also want to manage the cost appropriately. We'll talk about all those things in this short video. So the first thing is, who's to blame? You'll typically see, and I'm going to give you a case example. I'm going to show you the evidence of this, and you can come to your own conclusion. But you'll see that the hospital system needs to make more money as their costs increase. They want to pass that on to the insurance company. The insurance company is trying to figure out, when it comes to these external hospital systems, they want to manage that cost appropriately. Think about insurance costs. It's simply a function of the cost of healthcare. So as healthcare costs rise, so does the insurance premium needed the insurance companies have to take in to pay for those healthcare claims. So if a hospital wants to increase their rates, the natural function would be insurance costs for companies in that area are going to have to rise to pay for those. So think about the power dynamics that's here. You've seen a lot of this if you're watching this, in your city or your town, you've seen this happen over the last 10, 15, 20 years. Particularly since the ACA was passed and enacted over the last 10 years, hospital systems have consolidated. They've purchased other hospitals, they've purchased physician groups, primary care, specialty, imaging, and they've become vertically integrated. And what you'll typically find in any given market, your city, there's typically one or two really dominant hospital systems. They're the big power players. And if you think about an insurance company, name them out: Blue Cross, United Healthcare, Cigna, Aetna. They trade with their PPO networks to have everybody in that network. So particularly in an area where there's just one hospital system, if an insurance company wants to have employer clients, which they do, they've got to contract with that hospital. So who in that system has the power and leverage in a negotiation? You think about it, it's one hospital and there's four insurance companies. That hospital at least has a little bit of leverage there. And we've seen this case in point. The example I'm going to give you is Blue Cross, and it's the single hospital system in Abilene, Texas. But this is a perfect example. It's very recent, and it highlights the issues that are involved here and what it means for the employers in the Central West Texas market, and what it means also for you, because this is true there and it's true in every city nationally. A number of years ago, about 2014, you're going to see where this kicks in, how long it's been going on. Hendrick Healthcare System, it's the only hospital system in Abilene. And if you know anything about Texas, that area is not highly populated. That's a big city, or it's a big central hub, if you will, in central Texas. So if you live in any of those outlying areas and those rural communities, you're commuting into Abilene to have major services done. There's a lot of industry out there, a lot of employers, and they rely on that hospital system. And Blue Cross had a dispute with this hospital back in 2014. They ultimately fell out of network with Blue Cross, and Blue Cross lost a ton of business because of it. And the hospital knew that was going to happen, and ultimately the hospital system and Blue Cross came to an agreement, and it resulted in higher costs. Because if Blue Cross is having to pay more money to this hospital system for healthcare, those costs are going to have to be passed on to employers, which is passed on to employees, and it's an economic drain really at the end of the day, because the more companies pay for health insurance, it leaves less money for them to reinvest in their business and do other things that are more productive uses of capital. So who's to blame in that situation? Is it the insurance company? Is it the healthcare system? I'm actually going to take a little bit different spin on this, and I'm going to blame the government, specifically Medicare and Medicaid. And you might be thinking to yourself, wait a minute, what does Medicare and Medicaid have to do with commercial payments? And it really has to do with everything. So I want to illustrate what's going on here. The government, through Medicare and Medicaid, and for many hospital systems, it's either the largest payer, so the majority of their patients are government paid. It's either Medicare, Medicaid, or some other form of government payment, whether it's TRICARE or some other government paid insurance system, when you look at the payer mix of hospitals, and for some of these hospitals, the government is the primary payer, meaning the majority of their payments coming through the door are paid by Medicare, Medicaid, TRICARE, or some other government-run insurance system. The government doesn't negotiate with hospital systems. There's a mandated schedule that's paid. There's a price ceiling. And oftentimes hospitals, they struggle to make money. Oftentimes it's a break even. Perhaps they make a little bit of money. There's some margin in there to help compensate the hospitals, but it's not enough. When you look at hospital systems, and the data for the last 2 years shows that the average inflation rate for a hospital system is about 10%. So keep that in mind. That's to pay nurses, that's to pay other staff, janitorial, keep the lights on, operate their facilities. If their costs are rising at 10%, yet the government reimbursements are only going up 1 to 3%, you can see the math here. There's compression that's happening in those margins. And to begin with, they're not making a ton of money on those government-paid patients. So since they can't negotiate with the government, where can they negotiate? And that's going to be with the commercial insurers. That's going to be Blue Cross, United, Cigna, and Aetna. So they've got to find an outlet for a way to make more money. You can't negotiate with the government, so who can you negotiate with? It's the insurance companies. But who has the power there, right? We talked about that, the hospital system. If you're the only hospital in town or you're the dominant hospital system in your market, you can demand better pricing. Why? Because the insurance company doesn't want to not have that big hospital in their network. Otherwise, they won't be able to convince employers to buy their insurance. So you see the power dynamic here. But I'm going to go back to this Hendrick Hospital in Abilene, Texas, just to kind of highlight the example here. What I'm going to share here on screen is from Hendrick Hospital's annual financial report. And what you'll see here in their notes is, Hendrick Healthcare, they have a pricing policy they set what's called a charge master. That's just their billed rates. They determine those billed rates, and they contract with various commercial health insurance plans, which are paid based on a negotiated fee or a % discount on gross charges. So oftentimes an insurance company will tell an employer or a broker, hey, our average discount is 50% or 55% for these hospitals. And it sounds like a really good rate, but it's 55% off of what? It's whatever the hospital bills. So they kind of get to make that up. I've talked about that in different episodes and ways to address it, but that is somewhat of a problem. In our industry, you'll get a bill and it's $100,000 and you got a 55% discount, so you paid $45,000 for something. Medicare probably paid $8,000 for it. Just to give you an idea, maybe they paid $10,000, but are you really getting a good deal with a 55% discount? It's just an accounting game to make you feel good about what you actually paid for the service, but not for this example here. What I want to show you here is what's highlighted in yellow. This is true for many hospitals, but particularly for hospitals that are out in outlying metro areas. They blanked this out because this is proprietary. Less than some percentage of the hospital system's patients are insured by commercial payers. The majority of this hospital's patients are insured by government payers, which set the reimbursement rate for those patients without negotiation. So if you accept Medicare, you accept whatever they're going to pay for any particular procedure. So with that dynamic going back, if the majority of their patients are, the price is set by the government, there's a price ceiling, yet your costs continue to rise, that puts pressure on the hospital to be able to provide services and to be able to staff appropriately. Their costs are continuing to rise. There needs to be an outlet, and that outlet is you and me. We offer health insurance to our employees, and they're going to negotiate higher reimbursements from our insurance company, who's then going to turn that back on us. Really, ultimately, at the end of the day, what this turns out being is it's a hidden tax. The government's not paying enough, therefore we're going to subsidize the government system in a hidden tax to make sure these hospitals are able to continue to operate. Just to highlight how long this has actually been going on, I'm going to share a couple of news articles with you here. You can see that this started back in 2014. So back in 2014, the negotiations between Blue Cross and Hendrick Health System failed. Hendrick fell out of network. Blue Cross lost a bunch of employer clients out there. And ultimately, it took some time, but they came back to the table and they worked out a short-term agreement to come back in network at a higher reimbursement rate, which ultimately leads to higher insurance prices for employers and individuals who get policies through Blue Cross in that market. And this is true. Hendrick's done this with just about every insurance company that's out there. But you can see back in 2022, it came back onto the scene at risk of falling out of network. They've used a series of patches, if you will, to resolve this. And it's been ongoing for over a decade. They've been trying to get this figured out. And just last month, they worked out a long-term agreement, and terms weren't disclosed, but I'm willing to bet you it doesn't result in lower prices for anybody that's using that network out in Abilene, Texas, or the surrounding geography. So, as an employer, what should you be thinking about doing to solve this problem where you're not reliant on the network? Well, let me ask you this. Can you name me another industry or a good or service that you buy where the buyer and the seller don't meet to determine a price before something is purchased? I can't think of anything. I don't buy a Big Mac without being told what the price is before I buy it. I don't buy a car that way. I don't buy a house. I don't get a mortgage. I don't buy a television or a computer unless I know what it's going to cost before I buy it. And I usually have an opportunity to see from the seller what it's going to cost, and I get to determine, is that a fair deal or not? But with health insurance and health care, we turn that over to somebody else. It's a third party who ideally would have the best leverage and the best ability to negotiate the best price for me. But oftentimes we find that that's not often the case, because the insurance companies, again, they need to have that hospital and network, and they've got to have a big system where all the doctors and all the other ancillary providers are in their network. Otherwise, they don't have a good product to sell back to you as an employer, because your employees, my doctor's not in network, or it's usually you, the owner or CFO or HR, or it's your doctor's not in network, right? And that's not good insurance. Not good insurance because my doctor's not in it. And so the insurance company having to kind of play both sides of the fence, if you will, to make the hospitals happy, but then also make you happy. Ultimately, at the end of the day, they're a middleman in the transaction. So what are leading employers doing to solve this problem? They're bringing the buyer and the seller together, and that's by using what's called a direct contract. It's where an employer, usually through your advisor or your broker, will approach the hospital and work out an agreement. Typically, it's you can sometimes get 20 to 40% reduction in cost compared to letting your insurance company negotiate this. But you go to the hospital and you say, hey, we want to work out an agreement. We want our patients to come to your hospital. If we cut out this insurance middleman, what sort of agreement can we work out? And oftentimes you're going to get a better price for that. And it's not that your employees can't see or get care in other hospitals, but you're typically going to default to a network when you do that. So you give your employees a choice. You can go to this particular hospital. We have a better price there. You're either going to have a reduced or no copay, no deductible or reduced deductible. You can lower the cost to your employees because you're saving money in the process, and there's not a middleman in between you and the hospital or the provider of those services. Oftentimes to do that, now you can do that with a single hospital system if it's the only hospital in that market. It's not that you can't do it. You can. It's just a little bit harder, but it works best if you've got more than one hospital in a particular area, because then you've got a little bit of leverage there. Because what are those two hospitals if you got two in a system or two in a city, what do those hospitals want? They want preferential treatment. Well, if you're with one of the big PPO networks, who has preferential treatment there? Neither. It's just up to your employees and the hospital's marketing to drag them in. If you've got two hospitals or more, that you can go to one of those hospitals and work out an agreement where, hey, hospital CEO, CFO, we'll give you preferential treatment. If you give us a better price, we'll reduce out-of-pockets to our employees, and they're naturally going to gravitate to you because your hospital is going to be less costly for them. It's going to be less costly for us as the insurance company, where we're the ones paying for it. Employers pay for the majority of healthcare in an employer-sponsored plan. And the provider's happy because they're not having to collect money from patients, they're not having to send people to collections, and they're not having to write off bad debt for money that they don't collect. This was an interesting fact. I read in an article recently that the national average for hospitals on bad debt collection, they write off 75% of patient receivables, this seems astronomical to me. So if you can remove the collection risk, the payment risk from an employer for those procedures, you can make it timely, and they don't have the administrative burden of submitting a claim, having it denied by the insurance company, resubmitting it, waiting 60, 90, or 120 days to get paid. What's the value of that to that hospital system? These are the things that can get worked out when a buyer and seller come together and come to an agreement on the price. I hope this tip was helpful. If you could do me a really huge favor, if you could like and subscribe to this just to keep up to date with the latest news and updates in health insurance and healthcare for your business, I would really appreciate it. It helps give me the ability to keep creating content that's valuable and relevant for you. And until next time, use tips like this to put more profitability to your bottom line and more money in your employees' paychecks. Take care.